What do recent game-changing events in politics, policy, and the economy mean for investors? Well, few understand the Washington political scene and its impact on the markets better than our first guest. Tom Gallagher heads up the Washington Policy Research Team for ISI Group. Institutional investors have ranked Tom the #1 Washington analyst for 7 years running. And our next guest recently earned an impressive distinction. He was one of 5 finalists for Morningstar's new Manager of the Decade Award in the equity category. He is Stephen Romick, who has run the 5-star rated FPA Crescent Fund since he launched it in 1993. FPA Crescent is categorized as a balanced fund, but it can basically invest anywhere the bargains are, both long and short. And over the past 10 years, Crescent has delivered 11% plus annualized returns, putting Stephen in the top 1% of money managers. And our third investment star is another familiar face at WealthTrack. He is Charles Maxwell, Senior Energy Analyst at Weeden & Company. Barron's refers to Charlie as the Dean of Energy Analysts, and he was ranked the #1 oil analyst on Wall Street for many years in the past. So it's great to have you all assembled here for WealthTrack. Thanks so much. And, you know, Tom, lots of game changers recently, and certainly, you know, I went through a whole list of them. You can probably tell me, guys, which ones I missed. But as from your point of view in Washington, for investors, what is the biggest game changer that has occurred recently?
From your list, I choose the one that's outside of Washington, really. I think that Chinese tightening is clearly the thing that's driving the markets so far this year. If this had been the Fed in the past that started a tightening process, investors would know what to do. You pull out the playbook. The last several times the Fed did this, we had a choppy market, sideways market, really for 9 months. But things have changed. You know, I think one of the most important things is that while the U.S. is no longer the driver of global growth, the Fed still is the driver of global monetary policy. China is the driver of global growth, but so many countries are still tied to the U.S. through their currency pegs to the Fed that the Fed's really driving liquidity conditions. So I think investors don't really know what to do with this Chinese tightening. It's slowing down global growth. You see that in commodities as well as emerging market equities, but the Fed has still got the liquidity going. So I think markets are having a hard time adjusting to that. I think the events in Washington are very compelling, probably more in the political arena than the financial arena. And in the financial arena, I think the effects are more in the sector category than they are in the macro category.
All right, so we'll follow up on that. So, Steve, did I miss a major game changer, or do you think, what is your pick for the biggest game changer recently?
I don't really think there's been a huge game changer. I think it's really more of the same. I think that the seeds have been planted, and we're watching these unfortunate seeds still sprout. I don't think we really know a lot of what's going on. I think that as we look, it's like if your child, our economy has been sick, and the stimulus is the medicine. It's kind of like if your child has a fever, and you give them Motrin, you don't know if the fever's come down if it's because of the Motrin or because they're well. Once that Motrin wears off, then you're going to have a pretty good idea. And right now, we're dealing with still a lot of Motrin in the system. And as it gets pulled back, what's going to happen then? So I think it's really very murky to me.
So from an investor point of view then, given this murkiness, how do you proceed? What do you do?
The way we're looking at things is we always balance what is our upside opportunity versus our downside risk. And so we try and consider all these different things, likelihood of inflation versus the likelihood of deflation, likelihood of interest rates increasing, and if so, how much, what's likely to happen to, with respect to, healthcare reform. So all of these things create opportunities at different points in time, and there's pockets where there's downdrafts. Last summer and fall when healthcare reform was looking very good. This process was looking quite good in Washington. We didn't feel that there either be the political or the economic, wherewithal to really accomplish as much as people would have hoped. And so our healthcare exposure increased dramatically. So we look for things, like that in our portfolio. Right now, we have some names we can talk about later with respect to not that we're calling for high inflation anytime soon, but we'd like to at least be able to have something that can protect against it.
So in the healthcare space, what are the kinds of positions that you bought in the Crescent Fund?
Well, some of the insurance companies got destroyed.
Right.
So whether it be a WellPoint or a HealthNet are 2 examples of that. A medical equipment company like a Covidien is something else that we owned as well.
All right, and you still own them?
Yes, I still own all of those.
Charlie, from the energy sector perspective, I didn't mention anything that related particularly to that, but one of the things that you told me is that really one of the things that hasn't happened is there haven't been any game changers in the energy space. So in a way, it's back to the future, that for better or for worse, nothing has really changed. So where does that leave us in the energy space?
Well, I think we reached a peak of demand in the world in 2007, and now we're getting a rest. And
because of the recession.
Because of the recession, and it's very important. It's the same Motrin that story that Steve has,
right,
which is that we're getting a rest, and we're getting a rest for reasons that have really nothing to do with energy. And that rest should allow us to maintain demand down a little bit, and then across, and then up on the other side to about where we were in 2007 by about 212.
All right, yeah, exactly. So Whedon is saying really nothing much is going to happen with oil prices at any rate until 2012.
That's right.
So why not? Is it just that the global economy is not strong enough to really bump up demand?
The balance between supply and demand is fairly good. It's reasonable. There are the normal little changes day to day, but there is nothing really pressing it. The world probably will go into a higher demand growth, lower supply growth in about 2013, 2014, and then we're in trouble again, and then we'll have higher prices, and then the oils will begin to move again.